Welcome to Beyond Just Money by Kalkine Media, an independent global media house and investor relations group. Please note that this podcast is for information purposes only. It's not a solicitation or recommendation to buy, sell, or hold the stocks of any company or companies or engage in any investment activity under discussion. Kalkine Media is neither licensed nor qualified to provide investment advice through this platform.
Welcome to Beyond Just Money with me, Samta, and today I have with me Ms. Nidhi Sinha, who is the head of content of Kalkine Media. Every year, investors eagerly wait for capital allocation from the companies they hold positions in. And capital allocation can happen through dividend payouts, buybacks, and issue of bonus shares, among others. Among these, dividend is one of the most common allocations, as the other two have the potential to disturb the company's ownership pattern. And to discuss this, we have with us Nidhi, as I mentioned before. So Nidhi, welcome to the show, and can you please take our listeners through the importance of dividend for the shareholders, please?
Thank you, Samta. Dividends are indeed the most common allocation made to the investors. So important that it has led to tussles between the promoters and the management in some high-profile companies that we know of. So while investors want dividends as regular income, the management, being highly growth-oriented, usually tries to avoid distributing it, as that cash can be easily used to foster further growth within the company. To avoid this conflict, more and more companies are now coming out with transparent capital allocation policies.
Well, Nidhi, for the better understanding of our listeners, can you please explain what dividends really are?
Of course. Let's take the example of small businesses. So initially when they start, they have small capital requirements. But once the need for capital begins to grow, the companies start getting listed on exchanges to get excess funds and savings from the public. The company's ownership is basically broken in multiple small parts to be bought by shareholders. Now, since shareholders are kind of owners of the company, they have a right over the profits that the company makes. And this profit, when distributed among shareholders on a pro rata basis, is called dividend. To simplify it further, dividend is a portion of profits distributed by a company among its shareholders.
Well, if we see, Monday came as a bonanza to many investors across the globe, as the biggest of the US banks announced their plans to pay investors cumulatively an extra $2 billion of dividends next quarter. Could you take us through the latest developments in this regard, please?
Well, many American banks have already announced dividends, and Morgan Stanley's dividend push was the most aggressive of them all. The bank said that it would double its dividend to 70 cents a share in the third quarter of 2021. Additionally, the bank said that it would buy up to $12 billion of its own stock until June 2022. Meanwhile, Bank of America has said that it will increase its dividend by 17% to 21 cents a share. Earlier in April, Bank of America had announced a $25 billion share buyback plan. Now, coming to one of the most high-profile banks across the globe, which is Goldman Sachs, it announced that it has planned to increase its dividend by 60% to $2 per share, though that announcement is of course subject to the board's approval. On the other hand, JP Morgan Chase, the only Wall Street bank that is counted amongst the world's 5 largest banks, said that it would be increasing its dividend payout to $1 per share from the earlier 90 cents. That's an increase of 11%. And if you talk about Wells Fargo, the San Francisco-based bank, it has said that it will double the common stock dividend to 20 cents. However, Citigroup did not commit to any rise in its dividend payout, as its stress capital buffer requirement will go up this year.
So, Nidhi, can we say that the other financial institutions are also likely to have similar announcements in future?
Well, it is expected that the nation's biggest financial institutions and banks would begin distributing about $130 billion through dividends and share buybacks. Truist stated that it had planned to raise the dividend from 45 cents to 48 cents per share. Then Pennsylvania-based PNC had estimated to grow the dividend by approximately 9% to $1.25 per share. The increase in payments would be a good sign for the investors. However, it has received harsh criticism. US Senator from Massachusetts, Elizabeth Warren, criticized buybacks and dividends and emphasized to lenders to utilize their excess capital for the benefit of the employees instead.
To conclude, could you please tell our listeners what's behind this dividend rush?
Samta, if you look at American Central Bank Federal Reserve's last week's announcement, it said that 23 US banks had passed the 2021 stress test. It also said that the industry was well above the required capital levels in a hypothetical economic downturn. While the institutions would post $474 billion in losses in this scenario, the backup capital would still be more than double the minimum required levels. The test basically helped the American banks emerge out of the shadow of the pandemic. The increase in the dividends basically comes after the Fed loosened restrictions on payouts to shareholders, which were imposed during the COVID-19 pandemic.
Well, thank you so much, Nidhi, for discussing the dividends and why is the Wall Street hosting a dividend party with our listeners today.
Thank you, Samta. A dividend rush is always good news for the shareholders.
Well, to listen to this podcast again, please log on to our website, that is calkinemedia.com, or you could also go to our YouTube channel. Please don't forget to like, share, subscribe, and hit that bell icon to get notifications of the latest videos and podcasts. Until we see you next with yet another insightful episode of Beyond Just Money, stay apprised and invest right with Calkine.
Our listeners are requested to make their own inquiries about any investments, and Calkine Media strongly suggest that the listeners seek advice from a financial advisor, stockbroker, or other professional as necessary. Calkine Media hereby disclaims any and all the liabilities to any listener arising from any use of the information shared or discussed in this podcast. This podcast is available for personal and non-commercial use only.